Hello, value investors. Had a bit of a technical issues getting started, but I think that we're good. So today I'm going to talk about episode 6 of how to invest, and my hope is that as people come in, they kind of get involved and ask some questions. I wanted to talk about a few different ideas that came up, and I wanted to talk about buy and hold versus active investing. And I also wanted to talk about investing in leaders and what that means. And within that, I want to talk about Michael Maubousin's inside rates, inside view. So my idea is that I'm going to kind of talk about a few things about, this is a channel that I do on Friday at 9 a.m. and in the US. And I'm just going to help you think about some different ideas about investing. So when it comes to investing, ultimately everything that you do is about how you think about the strategy on the run up to the investment. It's not so much about the strategy when you are in the game, but it's really the run up to investing that's important. So for me personally, I don't believe in being a buy and hold forever. Now, let me just add some bit of dimension to that. So right now, a lot of people tell me, oh, Michael, Buffett says that his preferred holding period is forever. Well, a lot of stuff that Buffett says kind of has a bit of nuance. I'm not taking anything away from Buffett, but you do have to bit independently think about everything that comes out and that Buffett says. He's been a terrific source of, for decades of investors, helping them thinking about investing as a whole, but you do have to be independent in your way of looking at stuff. And everybody comes and says, oh, I want to be a buy and hold investor. I want a stock that will do me 15% per year, and I just buy and I don't need to do any more thinking. Everybody wants that. But that's not how it works, It's very difficult. And what else I'll say, there are two types of investors. There's that one that is kind of a buy and hold, irrespective of the valuation, and that works well until it doesn't. And then you have the other side, which is probably even worse, which is the investor that is not willing to face up and ask difficult questions. Now, the way that I get around this is that whenever I tell somebody, if you're going to buy a stock, write down 3 bullet points of why you're buying it, and make sure that one of those bullet points includes the valuation. Because when things go sour and the stock is falling, go back, read those 3 bullet points and see why you're wrong. Because if the stock is falling, the market says that you're wrong, you need to kind of double check that you are actually in the right. So go back and read those bullet points. And if you see that what you thought 6 months or a year or 2 years ago doesn't align with how things are going right now, walk away from investment. Now, just to be absolutely clear, companies don't really change that much over a 3 or 6 month period. Investors' perception may change quite dramatically, quite quickly, but the company doesn't change. So that's why it's important when you make an investment, make a commitment, you're thinking of yourself as the owner of that business, and you own that stock as a business owner, and you stay with it for a year. So just to add a bit more kind of nuance to that, it's not so much that you kind of buy and see where the share price goes, but you make a commitment. You think to yourself, okay, I want to own this business, and I have this rule that I do not exit my stock that I've held for less than a year. If you have made a purchase, I'm going to be committed to be the owner of this business for a year. After a year, everything is off the table, okay? If I was wrong, I'll be the first person to put my hand up and say, okay, I was wrong, I thought this and that transpired. But anything less, if you're kind of holding for, let's say, 3 or 6 months, it's a gamble. And it's going to be too much of the market's emotions telling you whether you're right or wrong. So the way that I think about it is that you have to understand your investment strategy before you get involved in this game. Now, that's not to say you don't improve over time. I'm constantly trying to improve, but it's to say, what type of investor are you? There's this quote from Adam Smith, the pseudonym, not the actual real Adam Smith, where it says that if you don't know who you are, the market is an expensive place to find out. And it really is about that. You got to figure out what kind of investor you are. And the way that I do it is I try and think of myself like, if someone gave me, let's say, pretend for the sake of the discussion, if someone gave me like 42 billion, would I buy something like Twitter, for example? Would that be a business that I would buy like that? And I try and think about it like that in that term. I try and think about the ownership that I'm taking of that business and whether that makes sense, to really think about it. And I think that it does. And, just try and think about it in those frameworks. Don't think about the share price. Oh, the share price is at $66 or whatever, and it's going to go to 70 and then I'll cash in and walk away. Don't think of it in that manner. Please do feel free. There's a few people on the call now, so feel free to kind of ask me a question. And this is really an interactive way of kind of getting involved with people and just seeing what people think. Okay, so one of the things that I wanted to highlight is that a lot of people are saying that they want to buy the best company with the best management, with the best margins, the best valuation, and you're going to have to compromise in some of those in somewhere, okay? Because everybody's trying to do that as well. So the way that I think about it is that you have to be compromising in one of those things. You might have to say to yourself, okay, I like this business. For example, it's a SaaS business, it's doing everything terrifically well, but the valuation doesn't work for me. And you might have to wait 6 months or so and revisit that at a valuation that does make sense. And if it doesn't make sense, pass over, there's another business. I would always try and kind of say to you, buy the highest quality business in that sector. Don't compromise. Don't go for the tier 2 company. Go for the best company, but think a lot about the valuation, because when the air comes out of the market, you'll see just so quickly how the sentiment compresses down. And often, it doesn't give you a lot of warning, and you're in a position that if you're paying a very large multiple, it's a very high inflated price, and you just kind of, the air comes out of the market and you're left holding that business that you're kind of like, I wish I hadn't paid such a big valuation for it. And everyone talks about, how many times looking back, something like Netflix was expensive. Everyone was always saying, I was saying, and many people were saying that Netflix was expensive. And in hindsight, yes, that was a terrific investment. But those cases like the Netflix or the Amazon or whatever, those names are so few and far between. You can't rely on a career of having those long shots. You need a process that allows you to compound your portfolio at 15% per year. You need to kind of think about moving the whole portfolio, not that kind of one name that in hindsight is the one. You can't invest in hindsight. You need to kind of take the facts that you got, and you got to build a semi kind of diversified portfolio. You don't need too many stocks. That's one of the things I say to people. If you got like 30 stocks, idea 31 isn't going to be as good as the first 1, 2, 3, 4, 5. Those are the best ones. That being said, I do tell you that it's important to think about it and to think about having the best ones, but not being all in the same space, because you can see that the market very much is not very discerning over different types of companies in the same space. So for example, if you look since, let's say, the start of the year, SaaS businesses coming from the start of the year into July, there was not a lot of divergence. The market now, since July, has started to kind of pick up and pick and choose the best, the safest investments, but it's quite difficult to kind of say whether the market will converge at some point. You don't want to have too much of the same idea in your portfolio. So you do need something around, let's say, 10 stocks. You don't need too many, but you don't want to have too few either, because if you have something, let's say 6 or 7 stocks, I've had that in the past, and that is really difficult, because what happens is that when the market sells off, you don't know how these things are related. I'll give you an example. So when COVID hit, before COVID, people would never have thought that, for example, let's say a cinema chain had anything to do with, let's say, the airline business. But that just all of a sudden, that COVID hit, and things that were not on the surface related all of a sudden became really interrelated. And you don't want to become overwhelmed when your portfolio implodes. So there are a few people on the call. If you want to kind of get involved and kind of ask a few questions, that's really what this is about. It's a chance for you to kind of ask a few questions and just see what I'm thinking about certain ideas or whatever takes your fancy. The other thing that I want to talk about is everyone is looking for high margin businesses, and high margin businesses appear to me to be getting a disproportionately high valuation relative to kind of a more traditional business. So if you go to businesses that are priced at, let's say, so the margins are approximately, let's say, 70%. Investors are thinking, oh, this is a really high quality business. But I own some of these businesses like that, and I have to be upfront and say, be very mindful of the valuation that you're paying for those businesses, because a lot of times the business has a high margin, but underneath the high gross margin, within the SG&A, the sales, and within different business line, within different lines of the income statement, they kind of put a lot of things in there that most likely is part of the underlying cost of generating the revenue. So be very mindful about valuations that you're paying for those businesses. The other thing that I wanted to highlight is that everyone is looking for compounders, and this side of the market is really so very much followed right now, that the valuations that people are paying for these businesses is really high. So I just wanted to say that be mindful not to kind of overpay for valuations. There's a few people on the call. If you kind of want to get involved and ask me a question, that's really what this is about. Do ask a question. The other thing that I wanted to say is that we're going into earnings season right now. This is a period that's quite difficult for your portfolio, and your portfolio may have a dramatic kind of, one of the earnings results might not go very well, and you are going to see your stock collapse, let's say, by 10, 15, 20%. Do the work before the earnings call to see what you're expecting. If it's a stock that, let's say, it's a very controversial stock, keep yourself alert to what is the key metric that you're looking for to validate your investment thesis, because when the earnings results come out, that's a very polished press release, and it might be distracting the information. Look concretely at the numbers that are important to you. I always tell everyone, if you want to look at a press statement from the earnings results, start at the end, start from the bottom and work up, because the things that the management are obliged to kind of tell you but they don't really want to tell you are at the bottom. The headline figures is there to distract you. It's there to build a narrative and to kind of focus here, focus there, but ultimately start at the bottom and work your way up. Look at the key operating metrics and see how they're performing over time. Get involved and ask a question if you want to. So one of the things that I kind of look out for, I try and see within certain themes, let's say in the advertising business, how is everyone kind of doing? Because if I see that, for example, advertising businesses are doing quite well, but I see that the stock that I own in advertising hasn't had a particularly strong quarter, try and figure that out, why that my business hasn't done particularly well. And perhaps it's just that, expectations were too high going in, but the underlying tailwinds to that sector are particularly attractive, and that doesn't change the thesis very much. So I try and follow a lot of these kind of businesses within the same sector, try and follow highly profitable opportunities, particularly in advertising. That's one of the things that I think is quite compelling. The other thing that I think is very interesting now is how the credit services, for example, the likes of Square or even Upstart, how they're disrupting the traditional banking system. I think that's going to be something that's quite interesting to look out for, particularly now in the upcoming quarterly earnings. It's going to be very interesting to see a lot of discussion around Bitcoin, how how these companies, a firm, whatever, are looking at Bitcoin and stuff like that, because I personally don't want to invest in Bitcoin, but I can see that, people do want to invest in that. And it just will be very interesting to see how management is going to be looking at those kind of things. For example, how would Amazon consider people paying with Bitcoin, and how is it going to be just the discussion around that. I think that's going to be something that's going to be quite interesting coming up now, and to see whether companies are going to be saying that this is something worthwhile doubling down into, because that a firm has this non-exclusive contract with Amazon, and a firm has already made some notification that they're going to start embracing Bitcoin to a certain extent. And if a firm is embracing Bitcoin, it will be difficult for Amazon, if they have a non-exclusive contract, not to kind of accept that as well as one of their payment solutions. So it's a very interesting upcoming quarterly earnings. I only have a few more minutes on the call. If you kind of want to get involved and ask me a question, this is a good time to ask a question. So there's a few people on the call. If you want to kind of just tell me like some of the interesting things that you're looking out for the upcoming earnings call, earnings season. One of the things that I wanted to mention is that a lot of people kind of say to me, "Oh, Michael, I want to invest, but I don't want to invest for a very long period. I just want to kind of look for something to kind of make me a return in 6 months or so." And I say that's really, really difficult. The only way to really invest is to allocate a portion of your capital that you don't really need right now for the next 2-3 years. And I call this the 20-year journey, because really it has to be like that. If you're gonna be taking investing seriously, anything less than 20 years, I mean, you're not gonna end up with anything worthwhile. You're most likely just gonna lose capital, because the market can be so volatile, and if you don't stick with it, you're gonna be left out and left behind. So you don't need a lot of capital to get started. You really don't. You can just do with, let's say, $500 a month. You just put that in every single month on the first of the month, irrespective of how the market is doing. There's a quote from Peter Lynch where he talks about, if you, since 1965, if you had invested in the market on the first of the month, every month for a period since 1965, your return would have been 10%. And if you had picked the absolute bottom of each month, the best entry point, your return would have been 11.5%. So it's a miserable 1.5% outperformance by you being able to time the market, which just goes to emphasize the importance of really sticking with investing. And I call it a 20-year game, because I think that 20 years is something that is achievable for most people, even if you're kind of in your late 50s and you're getting started into investing right now. It's something that's very, very achievable, and you can, if you're committed to it, and on the start of each month you put down some of your savings, it really snowballs very quickly. And one of the facts that I always tell people is, if you're a great investor and you compound, if you put 5k down and you compound at 16%, after 20 years, that's 94k. And if you're a less good investor and your return is 13% per year, and you just put 500k down, 5k down at the start, and you add 500 per month, which is not a lot of money, $500 per month, at the end of the 20 years, that's 514k. So that's like more than $500,000 over 20 years. And we're talking $500 is not a lot of money that for you to be investing in the market and thinking about helping yourself and helping your family out. We just got a couple more minutes on the call. If I would love to kind of hear some questions from you and to see what you think. Someone wrote to me about my thoughts on stop losses, and I tried to address that last week. And it's very difficult to have a stop loss and to be thinking like a business owner. There's the quote that I gave you last week about Peter Lynch, where it says, show me a 20%, a person with a 20% stop loss, and I'll show you a person with a 20% loss. Because the market is just so volatile, and you're going to be left out of the market anytime that the market's volatile and you have a 20% stop loss. You're just going to be left out, and then you're not going to be emotionally predisposed to buying into at the absolute bottom, because at the absolute bottom you'll be just so happy that you're out of that stock and you see that stock falling lower, and when the stock comes back up, you're like, oh, I'm not going to get in right now, I'm going to wait for the pullback, and that's not the best way to think about it. About investing is really about a journey where it's staying invested, staying committed, and thinking about your prospects over the next 20 years. It's not about how you're going to do in the next 2-3 years. It's really a profession. It's really something that you have to be quite disciplined, and you do have to study around and think about investing. You do have to read a little bit about it, and you don't need to do too much work. It's not looking at your screen every day as some people do. Some people just look at the share price every day. That doesn't tell you anything. You have to kind of dig around and look at the earnings call. You have to read through the 10Q. It's not a lot of work. It's a bit of work every 90 days, but you kind of, you do have to get involved, and 4 times in the year. So anyway, I don't think there's any calls on the call today. There's no questions on the call. So I hope to see you next time. Okay, bye-bye.